I'm working on how firms make decisions with respect to their financial reporting and how that impacts their cost of borrowing. Firms have a choice. They can either report their financial statements by conveying information to the stakeholder, or they could use their financial statements to mislead the stakeholder by painting a rosy picture when things may not be all that good. What is currently missing in the literature is how these financial reporting choices are made in the context of the firm's relationships with stakeholders other than the firm's shareholders. So most of the research papers have examined how shareholders are impacted. But what we focus on are how other stakeholders that are vital to the firm, such as the firm's suppliers, the firm's customers, the firm's creditors, how these stakeholders are impacted and what the resulting consequences are for the firm. What we find, interestingly enough, is firms have this tendency to use their discretion to paint a rosy picture more often than not. They tend to manage earnings in a way that results in inflated earnings and makes the firm look much better. And as a consequence, the consequences were also interesting. We find that suppliers, customers appear to recognize at least partly what's going on and respond in a way by not committing themselves as much as they otherwise would. Yeah, these practices are legal and they're generally within the bounds of what is accepted principles, accounting principles. But what's at issue here is, given the discretion and responsibility that managers have in reporting the outcomes at the firm, the question is, are they thinking in the best long-term interests of all the firm's stakeholders, or are they using their discretion in a way that maximizes their own self-interest in the short term? I think that's the key issue here. So I hope that students will look at decisions that firms make not just as impacting one segment of the firm's stakeholders, but to realize that it has a real impact on a variety of stakeholders.